You could be losing thousands of dollars because of simple, avoidable mistakes. These mistakes aren't always obvious, especially if you're new to the game, but even experienced investors fall for them. Today, I'm going to walk you through 5 of the most common crypto mistakes, explain exactly why they happen, and break down how you can avoid them. By the end of this, you'll be better prepared to keep your hard-earned money safe and grow your investments. To help you avoid making expensive mistakes, check out Crypto Hopper. It's the world's most customizable crypto trading bot that helps you automate your trading, removes emotions from your decisions, and helps you trade like a pro without having to actually be a pro. But don't take my word for it. Use the link in the description to sign up for a free trial and see for yourself if it lives up to its claims. Mistake 1. Letting emotions control your decisions. Crypto markets are fast-paced. Prices go up and down constantly, and it's easy to get caught up in the hype or panic. There's a psychological trap called FOMO, which stands for fear of missing out. Here's how it works. Let's say you hear about a coin that's skyrocketing in value. People online are talking about their massive gains, and it feels like if you don't buy in right now, you'll miss your chance to make money. That fear pushes you to buy at the peak of the hype, which is usually the worst time to invest. On the flip side, there's panic selling. Let's say you've invested in a coin, and suddenly the price starts dropping. It feels like the floor is falling out, and you might lose everything. To avoid further losses, you sell. But a lot of the time, that drop is temporary, and the price bounces back later. By selling in a panic, you lock in your losses and miss out on the recovery. The solution to both FOMO and panic selling is having a strategy. One of the simplest and most effective strategies is called dollar cost averaging, or DCA. Instead of investing all your money in a coin at once, you invest small, fixed amounts at regular intervals, like $50 every week. This spreads out your purchases over time and helps you avoid buying at the worst possible moments. Whether the market is up or down, you're sticking to your plan, which keeps emotions out of the equation. Another important part of avoiding emotional decisions is thinking long-term. Crypto isn't a get-rich-quick scheme. It's a volatile market, and short-term swings are normal. Instead of worrying about daily price movements, focus on your goals. Are you holding Bitcoin for 5 years? Do you believe in Ethereum's technology? If you've done your research and believe in what you're investing in, stick to your plan and avoid impulsive decisions. Mistake 2. Missing out on bull market opportunities. A bull market happens when prices across the crypto market are rising. This is when people feel optimistic, and there's a lot of activity. What many investors don't realize is that bull markets are the perfect time to take advantage of bonuses and rewards offered by exchanges. These aren't just small perks. They can add up to hundreds of dollars in extra value. For example, during bull markets, exchanges like Binance, BitGet, or Coinbase usually roll out promotions. They might offer sign-up bonuses where you get free Bitcoin just for creating an account and depositing some funds. There are also referral programs where you can earn rewards by inviting your friends to use the platform. Some exchanges even hold trading competitions with cash prizes or giveaways for completing certain tasks. These offers are essentially free money. If you're already planning to trade or invest, it makes sense to take advantage of these opportunities. To find these deals, keep an eye on the promotional pages of major exchanges or follow their official social media accounts. Just make sure you're using reputable platforms. If a promotion sounds too good to be true, it might be a scam. Mistake 3. This one trips up a lot of beginners, valuing a coin based on its price instead of its market cap. When you're new to crypto, it's easy to look at a coin's price and think, this one's cheap, so it has more potential to grow. But the price alone doesn't tell you how much a coin is worth. To understand its real value, you need to look at its market capitalization, or market cap. The market cap is calculated by multiplying the coin's price by the number of coins in circulation. It shows how much money has been invested in that coin overall. A coin with a low price might have billions of coins in circulation, making its market cap high. On the other hand, a coin with a high price could have a smaller market cap if there are fewer coins in circulation. Let's break it down with an example. Say there's a coin priced at $1 and it has 1 billion coins in circulation. Its market cap is $1 billion. Now imagine another coin that costs $20,000 but only has 50,000 coins in circulation. Its market cap is also $1 billion. Even though their prices are wildly different, their total value is the same. This is why you shouldn't assume a coin is a better investment just because it's cheaper. Always check the market cap to understand the bigger picture. Coins with smaller market caps often have more room for growth, but they can also be riskier. Larger market caps tend to be more stable, but their growth may be slower. Mistake 4, going all in on altcoins during altcoin season. Altcoin season is when smaller cryptocurrencies, called altcoins, start outperforming Bitcoin. This usually happens when Bitcoin's dominance in the market decreases and more money flows into other coins. During altcoin season, it's common to see altcoins making massive gains, sometimes doubling or tripling in value within weeks. While it's tempting to go all in on altcoins during this time, it's a risky move. Altcoins are generally more volatile than Bitcoin or Ethereum. They can rise quickly, but they can crash just as fast. If you put all your money into altcoins and the market shifts, you could lose a massive portion of your investment. That's why it's so important to have a balanced approach. Diversify your portfolio so you're not overly reliant on one type of coin. Holding a mix of Bitcoin, Ethereum, and a few altcoins can help you benefit from altcoin season without exposing yourself to too much risk. Remember, crypto is about managing risk while maximizing opportunities. Mistake 5, not knowing where to buy altcoins. When you hear about a promising new coin, the first question is, where can I buy it? Not all coins are available on popular exchanges like Binance or Coinbase. Many are listed on smaller, less familiar platforms or decentralized exchanges DEX. While DEXs like Uniswap or PancakeSwap offer access to a wide range of coins, they also come with risks. One major risk is buying fake tokens. Scammers often create counterfeit versions of popular coins with identical names or symbols. If you accidentally buy one of these fakes, your money is gone. To avoid this, use tools like CoinGecko or CoinMarketCap to find the correct token. These platforms list the official contract addresses for coins, so you can verify you're buying the real deal. Once you have the contract address, double-check it on the exchange before making a purchase. It's also a good idea to stick with well-known exchanges whenever possible. To recap, here are the 5 mistakes to avoid. Letting emotions control your investments, missing out on bull market opportunities, focusing on price instead of market cap, going all in on altcoins, and not knowing where to buy altcoins safely. Have you made one of these mistakes before? Are there any other avoidable mistakes that you would add to this list? Let me know in the comments below. And if you found this helpful or interesting, make sure to like and subscribe for more videos like this.